Before we get into it, stay with this one until the end, because the seventh sign is the one most investors never notice until it's too late, and understanding it changes the way you'll look at every company you ever research again. Picture someone sitting at their kitchen table, scrolling through a stock app at 11 at night, watching a ticker climb and fall by fractions of a percent, feeling that familiar tightness in the chest that comes from not knowing whether to buy, sell, or simply close the app and pretend the decision doesn't exist. This is the moment most people live in when it comes to investing, a moment defined not by analysis but by anxiety, because the information is endless and the noise is louder than the signal, and somewhere underneath all of it is a simple truth that gets lost in the chaos, which is that great companies tend to reveal themselves through patterns rather than through hype. And once you learn to see those patterns, the anxiety starts to fade into something closer to clarity. The core idea we're exploring today is that a stock worth buying rarely announces itself with fireworks, and instead it tends to whisper through a handful of consistent signals that show up again and again across decades of market history, signals that have less to do with predicting the future and more to do with recognizing durable strength in the present, because the companies that compound wealth over long periods of time are usually not the ones making headlines, but the ones quietly doing the same disciplined things year after year, and learning to spot those things is really the entire game. The first sign is consistent earnings growth over multiple years rather than a single spectacular quarter, because a company that grows its profits steadily through different economic conditions is demonstrating something more valuable than luck. It's demonstrating a business model that can adapt, and when you see revenue and earnings moving upward together over a 5 or 10-year window, you're looking at a company that has proven its ability to survive more than one version of the economy, which matters far more than any single earnings beat that grabs a headline for a day and is forgotten by the following week. The second sign is a durable competitive advantage, something analysts often call a moat, and this shows up as pricing power, brand loyalty, network effects, or simply a cost structure that competitors cannot easily replicate. And the psychological reason this matters so much is that human beings are drawn to novelty. We get excited by new entrants and disruptive stories, but the market has shown repeatedly that boring, defensible businesses tend to outperform exciting but fragile ones over long stretches of time, because a moat protects future cash flows from the erosion that competition naturally creates. The third sign is manageable debt relative to earnings. And this is where the math starts to matter in a very concrete way, because a company carrying debt that is only 2 or 3 times its annual earnings before interest, taxes, depreciation, and amortization is in a fundamentally different position than one carrying debt at 6 or 7 times that figure. Since the former has breathing room during downturns, while the latter can be forced into painful decisions the moment revenue softens, and this single ratio has been the quiet difference between companies that survived recessions and companies that didn't. The fourth sign is a return on invested capital that consistently exceeds the company's cost of capital, and here the math becomes almost elegant in its simplicity, because if a business can borrow or raise money at, say, 6% and consistently deploy that capital into projects earning 15 or 20%, it is compounding value for shareholders every single year that this pattern continues. And over a decade, the difference between a company earning 8% on capital and one earning 20% on capital is not incremental. It is often the difference between a stock that merely tracks inflation and one that multiplies an initial investment several times over. The fifth sign is free cash flow that grows in tandem with revenue, because earnings can be shaped by accounting choices in ways that cash flow simply cannot. And a company generating real, growing cash after covering its operating and capital expenses has the flexibility to reinvest, pay dividends, buy back shares, or weather a storm without needing to borrow. And this flexibility is often what separates companies that thrive during uncertain periods from those that quietly struggle behind a still attractive income statement. The sixth sign is a management team that treats shareholder capital with the same care they would treat their own money. And this shows up in disciplined capital allocation, transparent communication during difficult quarters, and a track record of buybacks or acquisitions that actually created value rather than destroyed it. And the psychological piece here is worth sitting with because we tend to trust confident language more than accurate language. And the leaders worth following are usually the ones who speak plainly about both successes and mistakes, rather than the ones who promise perfection. The seventh sign, the one we teased at the start, is a little different from the rest because it isn't really about the company at all. It's about the investor's own relationship to time, and it comes down to this: that the strongest signal a stock is worth buying is your own willingness to hold it through a decline of 30 or 40% without panicking. Because if you've done the work on the first six signs and you still can't imagine holding through volatility, then the position is probably sized wrong or the conviction isn't really there. And this final sign is the one that determines whether all the analysis in the world actually translates into long-term results, since the math of compounding only works if the money stays invested long enough for it to work. Zooming out from any single company for a moment, this whole framework points to something larger about how markets actually function over time, because prices in the short term are driven by emotion, speculation, and narrative, while prices over long periods tend to gravitate toward the underlying economic reality of a business. And this is why the investors who consistently do well are rarely the ones with the fastest reflexes or the most exciting predictions, but instead the ones who built a repeatable process for identifying quality and then had the patience to let that process play out across years rather than days. And once you internalize that markets are essentially a mechanism for transferring wealth from the impatient to the patient, these seven signs start to look less like a checklist and more like a filter for staying calm in an environment designed to make everyone anxious. There's also an identity shift that tends to happen once someone actually adopts this way of thinking, because the version of you that stares at the ticker every night, reacting to every headline, gradually gets replaced by a version that checks in periodically, evaluates a business rather than a stock price, and feels less like a gambler and more like a partial owner of real companies doing real things in the world. And this shift matters because it changes the emotional experience of investing from something stressful into something almost quiet, since you're no longer trying to predict the next 24 hours, but instead trying to understand whether a handful of businesses remain fundamentally sound over the next several years. And that's a much easier question to answer with confidence. None of this guarantees outcomes, and every investment carries risk that no framework can fully remove. But understanding these seven signs gives you a way to think clearly in a space that often rewards clear thinking far more than it rewards speed or intuition. And the goal was never to hand you certainty, only a better lens, one that lets the noise fade a little and the signal come through a little more clearly each time you look at a company and ask whether it's actually built to last. If this way of thinking about stocks made sense to you, take a second to like the video and subscribe, because there's more of this kind of grounded, patient thinking on the way, and it helps more than you'd expect.